everyone, welcome to Startup Street. I'm Arundhati Ramnan, and with me, as always, is Ritu Singh. These are top headlines from the startup world. Agnikul Cosmos raises $26.7 million in a Series B round with Celesta Capital, Rocket Ship VC, Artha Venture Fund, and Artha Select Fund joining the cap table. The space tech startup will use funds towards enhancing technology, building facilities, and testing systems.
Invesco marks up Swiggy's valuation to $7.85 billion at July's closure. Invesco had previously cut the food tech's valuation to under $5.5 billion. Meanwhile, Swiggy's month-on-month volume grew 7% this July and 6% in August, beating Zomato on both months.
Sports tech platform Game Theory secures $2 million in a pre-Series A funding round led by Rainmatter Capital, tennis player Rohan Bopanna and others. The fundraise marks Nitin Kamat's foray into the sports category.
Microsoft-owned LinkedIn will lay off 668 employees globally in its second round of job cuts, impacting India as well. The social media network is grappling with a slowdown in hiring. The cuts will affect LinkedIn's engineering, product, talent and finance teams.
Online community for developers Stack Overflow is giving pink slips to 28% of its staff, which is over 100 employees as it struggled towards profitability. CEO Prashant Chandrasekhar says, "We are significantly reducing the size of the go-to-market organization as well as supporting teams and other groups." Those were the headlines that we're tracking for you this evening. But on what's brewing today, Invesco, a US-based fund manager, has raised the fair value of food and grocery delivery platform Swiggy to nearly $8 billion. Remember, Invesco, which is an investor in Swiggy, had earlier slashed the company's valuation twice in 4 months. In its July filing, the asset management firm raised Swiggy's valuation to $7.85 billion from $5.5 billion in April. While the move represents a 42% increase from what Invesco had last valued Swiggy at, the startup's valuation is still 30% lower than what it was in January 2022. Swiggy was valued at $10.7 billion when Invesco led the $700 million fundraise in 2022. The asset manager considers valuation of peers as a factor when assessing the value of its startup investments. Now, with the increase in fair value, Swiggy's valuation of $7.85 billion was closer to rival Zomato, which was valued at around $7.7 billion as of July. Additionally, the food delivery space in India is growing at 10% sequentially in July to September, according to a report by UBS Securities. Swiggy saw higher volume growth compared to Zomato as its month-on-month volume grew 7% in July and 6% in August, beating the rival in both months. This is not the first time the food tech giant's valuation has been marked up. After a wave of valuation markdowns, US-based asset management company Baron Capital Group in August had also marked up the valuation of Swiggy as of June 2023.
In other news, Indian space tech startup Agnikul Cosmos, which is incubated by IIT Madras, today announced that it has raised 200 crore rupees on $26.7 million in a Series B funding round, taking the total capital raised to date to $40 million. Now, this round saw participation from Celesta Capital, Rocket Ship VC, Artha Venture Fund and others, as well as the existing investors. Agnikul aims to use these funds to support its expansion plans as it looks to put satellites in the orbit. Joining me now to discuss this and the company's plans ahead is Srinath Ravichandran, the co-founder and CEO of Agnikul. Srinath, welcome to CNBC-TV18. If you could start by taking us through this 200 crore check you've got. How exactly do you plan to deploy it?
Hi, thank you for having me here. So deployment of this capital is going to be used primarily for scaling, right? We are starting to think about what beyond the first, set of launches, what should be done, go to multiple launches a month and so on. So this is about scaling in all aspects, focusing on quality, production, multiple launchpad access and so on. So that's what this capital is for.
I see. You've been gearing up for the launch of your suborbital rocket, Agniban. Can you give us what timelines you're working with? When should we expect the first commercial launch?
Yeah, so we've been looking at doing a technological demonstrator launch out of our own, private launch pad within Sriharikota that the government has allowed us to set up. This is going to be a validation of all of our key technologies on the avionics side, on the engine side, and more importantly, it's going to be a semi-cryogenic engine launch that is being, 3D printed at our facility. Tracking a timeline of, probably by the end of this year or even before that. Of course, we'll have to work with the monsoon season as well as we go through the testing. So, but that's where we are tracking. It'll be a key validation of all of the technologies we have, developed in house.
Indeed, it will end of the year. That's the key deadline to watch out for. But what next, Srinath? What happens after this first launch or the first few launches? What kind of tech and infrastructure are you putting in place to be able to handle multiple launches a year in the future, not just one?
Yep. So we have already, a rocket factory facility within the IIT Madras Research Park area where we are able to make 8 rocket engines every month, right? But that is only about rocket engines. And then, of course, there is more to the rocket than the rocket engines alone. So this capital is going to be used for setting up of some small facilities for doing, other parts of the vehicle, like say some aspects of the indoor tank structures and things that connect different stuff and so on. Beyond that, I think what is important as an aerospace company is to continuously focus on quality, right? So some of this capital is going to be used for hiring the right kind of people who can look at operations, production quality. Some of it is also going to be used for having the right kind. Every launch, if you look at it, right, is actually not only just building a product; it's about an extremely well-organized event management function. Right. So that's a very different kind of skill set from maybe just hiring designers or so on. So that we're going to be focused on all of those things as well, probably looking at a certain set of certifications that are required in this industry as well. So that's basically going from, say, the first 5 launches to the next 100 launches. That's what this is about.
So what will these first 5 and the subsequent 100 launches mean in terms of your top line and bottom line growth? If you could start by telling us where you're currently at with both your revenues and profits.
So we get to do a first test launch. So that basically is going to be the starting point of the revenue for us, right? So once we get into the commercial phase is when we'll actually be gearing up on revenue. I think what is going to happen over the next, 25 or 30 launches is we'll get into the sort of, quasi steady state wherein we'll be able to actually put out the actual steady state pricing that we believe, is right for this market, while at the same time optimize on the supply chain and so on. So in terms of bottom line and top line impact, I think what is going to happen is, beyond the costing aspect of it, which we believe will be among, the lowest in the world, that is not the real focus of Agnikul. We are here to provide on-demand launch access, enable people to have customizable, solutions to go to space. A launch vehicle or a rocket need not be a one-size-fits-all configuration. What matters to a customer is how quickly they can go to space and at what price they can do it economically. So that's what we're going to be focused on. I think there is decent margin built into the very manner in which we have built out our technology, right? So like using 3D printed engines, using clusterable, configuration of engines, using extremely modular avionic packages and so on. So I think all of that will play into both our profitability and also, generally the addressable revenue itself.
Srinath, we understand you've received some inbound interest from potential launch customers. Companies in Europe as well as Japan signed some MOUs as well. Could you tell us who these potential customers are and what sort of interest have you received so far?
Yeah, we're working with a bunch of customers across Europe and Japan. I think what has happened, first of all, is with the whole Chandrayaan story going up, I think the entire Indian sector, including the private players, we've all gotten a huge boost of credibility across the world, right? So thanks to ISRO for that. And also the clarity from the government side on both policy and in terms of what is allowed from the country. This has given extraordinary, confidence to everyone, investors, customers, vendors across the world on what a private Indian company can do in the market. So I think in terms of MOUs, in terms of, other engagements we have with players, it is really about, either the imaging satellite folks or the telecommunication folks, or even people who are starting to look at space more as a platform, right? If space used to be a destination, you go there and you take pictures, or you go there and you bounce off signals. But today that is changing. People are going to space because it offers vacuum, low temperatures, microgravity. So you have a whole new class of customers that are coming up, people who want to go to space to take advantage of what space offers. So we are actually talking to a lot of them as well. I think the end goal of all of these conversations is about making space accessible on demand, making it easily reachable for people. And that's what all of this is about.
Sure, but no names shared there. But, very quickly, you said before that Agnikul was looking to complement ISRO, fill the gap which is not directly addressed by it, and you're targeting to handle launches in the less than 300 kilo payload segment. What are the plans on that front briefly, and what is the sort of annual demand you're anticipating there?
Yeah, I think there is enough demand to even address, about 15 to 20 launches a year, or probably even a launch once in 2 weeks, right? And I think in terms of, if you look at a customer, global customer, and space is always a global market, right? If you look at them coming in and looking at India for a potential launch, if you look at the category of launch vehicles that have a capacity of less than 300 kg, I think we are the only ones out there. So in that sense, we are adding, we believe, to the fleet of vehicles in the country that is, which is where there's a gap. So that's why we believe you're complementing ISRO and adding on to what is available for a customer globally. In terms of what this means in terms of tapping into the demand, our understanding is there is about 50 tons going to orbit every year in the lowest class of payloads. And even if we do 25 launches a year, I'd say approximately 100 to 150 kgs or something per launch, you're still going to be addressing only 3 tons per year. And that is still a fraction of what is the actual global demand today. So I think there's a lot of room for improvement, for expansion, for being more efficient, and that's what is going to be our focus.
Well, Srinath, that's all the time we have. Thanks very much for sharing your thoughts here on CNBC TV18. On that note, Arundhati, it's back to you in the Mumbai studio.
Thanks for that, Ritu. On that note, it is time for us to head into a short break. But on the other side, InsurTech startup Insurance Deco backed $60 million in its ongoing Series B funding round. We put the founder, Ankit Agarwal, and one of its investors, Sagar Agarwal of Beams Fintech, on the hot seat to find out how they plan to use the funds. Stay tuned for that.
Welcome back. You're watching Startup Street. Now, on what's brewing as well, Microsoft-backed LinkedIn has laid off close to 700 employees in the second round of job cuts undertaken this year, and that impacts India as well. The layoffs are going to affect 668 employees across engineering, talent, and finance teams. In an email sent to employees, LinkedIn said it was reorganizing to improve agility and accountability.
InsurTech startup Insurance Deco has raised $60 million in its ongoing Series B round. The latest capital infusion is a mix of equity and debt. The startup has also onboarded new investors, including Japanese giant Mitsubishi UFG Financial Group, BNP Paribas Cardiff, and Beams Fintech Fund. Further, this marks the second fundraise for the Gurugram-based startup in 2023. So how does the firm plan to use the funds, and what's the growth strategy? Joining us now are Ankit Agarwal, CEO and founder of Insurance Deco, and Sagar Agarwal, the managing partner of Beams Fintech Fund. Ankit, let me come to you first. You've raised $60 million. How much of it is equity and how much debt? This is the second fundraise in the last 12 months, totaling now to $200 million. So what's the deployment plan, and any more fundraisers planned for this fiscal?
So, firstly, thank you so much for having both me and Sagar over on the show. We really appreciate this. Majority of the amount that we've raised is in equity. We cannot go into specifics of the split between equity and debt. We've raised about $200 million, over $200 million during the course of the year. Most of the fund is going into investment in tech product, investing in creating a more known brand. We will be investing in brand campaigns. Third, there are a couple of M&A opportunities which we're chasing. Fourth, we've identified some new business areas, like we would want to get into the reinsurance space. So these are 4 broad areas which we will look at investing the capital. From a capitalization perspective, I think the company is sufficiently capitalized. 4 businesses broken even. We burning minimum sum of money. So I don't think we will look at raising more capital. But in business, you never say never.
Never say never. But Sagar, let me bring you into the conversation. You're primarily a fintech investor. So what made you bet on Insurance Deco? What was the rationale? And how exciting is this space?
So I think, thank you so much for having me over as well. I think we spent a lot of time on the insurance space overall, both manufacturing and distribution side, right? And we've seen that space is challenged with not just affordability and accessibility problem, but also mis-selling and mistrust, right? And within this complex space of insurance, we found Insurance Deco to be building an extremely technology-led platform, right? Extremely robust platform, solving the problem of both Bima as well as unemployment problem in India within the agent network as well, right? And this is led by an incredibly solid team of Ankit, Ish, and the entire group, right? Building a solid platform, solving a large problem of reaching out to millions of agents in India, and at the end of the day, millions of customers in India. So given the way the platform is growing and given the way distribution of segment in India is improving, we invested in Insurance Deco along with our other investors, both MUFG as well as Cardiff. And given the opportunity in the Insurance Deco from a next 10-year perspective, the way our IRDA chairman, right, thinking about the way sector is evolving, all of this led to spend more time and obviously trust on Ankit and the team to build a larger solution and solve the penetration problem in India.
All right. And, as you were saying, solving the penetration problem, Ankit, where is the big growth coming from? As we understand, you get over 90% off like your premium from tier 2 cities and beyond. So what is working in these markets for you?
See, let's understand, insurance is a financial product where you actually ask for money. You don't give money. It's a promise that you sell to people that if something happens to you, we are going to be there for you. So when you're selling something like that, you want to make sure that there is somebody whom you know who's selling the policy. And we at Insurance Deco of the firm believe that over the next 10 to 15 years, complex financial products in the country are going to be sold with a digital touch. And that's where we are focused on. Tier 2, Tier 3, Tier 4 markets in the country are still relationship markets where people want to buy from people whom they know. We've been able to create an agent base of over 220,000 people who work with us, who use our platform, leverage on our platform to go out and explain the need of having insurance to consumers and thereby servicing.
Right. And Ankit, what about your top and bottom line? Give us a sense of the numbers you're clocking. What's the FY24 target for you?
So as we speak, we are on an annualized premium run rate of 3,000 odd crores. By the end of this year, we should get to an annualized premium run rate of anywhere between 5,400 to 5,800 odd crores. We are a IRDA regulated entity, so our remuneration, etc., is within the prescribed limits of the honorable regulator. From a profitability perspective, the core business for the company is making money. There is some investment we are doing in new initiatives because we believe we want to continue to grow at 70-80% every single year for the next 5 years. Hence, we are making some investments there, and that is leading to some burn, which is very marginal. As a company, we should break even during the ongoing quarter, and Q4 should hopefully help us generate enough EBITDA to make sure that we are break even on a full year basis too.
So breaking even in this quarter. Sagar, as you were talking about penetration, and now the insurance sector suffers from very low penetration, as you pointed out. So how key is technology when it comes to expanding in the space?
See, I think if you look at any financial services business, right, the core of the business has to be a proper business model, and tech can only be an enabler on top of that, right? Similarly, what Insurance Deco is doing in this category, right, they've built a large distribution mechanism in the market, right, with large number of agents, almost 150,000 agents, right? But all of these agents can only be managed at scale if you have a robust technology platform. So reaching out to more and more consumers, right, both through B2B channels or B2C channels or B2B2C channels, you need a technology platform where you can embed the journey of the consumer. And a lot of contextual selling can happen thanks to the technology platform where you can underwrite the customer better, you can reach out to the customer better, your communication engine can be stronger. So tech plays a very important role, but at the end of the day, you need to have a strong execution capability in the business at the back of it to be able to use the tech to effectively reach out to more and more people. That's the only reason today Insurance Deco today are present across 1,800 cities, right? A majority of the PIN codes today in India is directly and indirectly captured by Insurance Deco. If it wasn't for technology, they wouldn't be able to reach out to as many agents and as many insurance companies at the same time.
Absolutely. So tech obviously playing a huge part there. But Ankit, you're also going to use these funds for inorganic growth. Are you in talks with anyone? Earlier this year, you'd acquired Verac. So where's the integration on that front? Any other companies on your radar at this point?
We've actually amalgamated with two companies. One is Verac. You've already mentioned it. So Verac has helped us launch the SME journey, and we're one of the first companies in the country on the insurance distribution side to go live with the SME journey. The second was a Gujarat-based insurance distributor IRSS. So that also we've integrated. As we speak, we're currently talking to multiple folks, both on the distribution side as well as on the technology side. Given the sensitive nature of these conversations, I cannot share more details. But hopefully, if everything works well, you should see us announcing a couple of deals soon.
All right, so a couple of deals coming soon there. Ankit, Sagar, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best going forward.
Thank you so much. Thank you, Ankit.
All right. Early stage investing platform Indian Angel Network recently appointed Priyank Garg as managing partner of the Alpha Fund, the second in the series of the group's funds. IAN Alpha Fund was launched in October 2022 with a corpus of 1,000 crore rupees, more than double the size of its first fund. Speaking to my colleague Aishwarya Anand on the sidelines of Delhi Sustainability Summit, he said that the fund is expecting to announce the first close very soon.
So last year, IAN Alpha Fund was launched with a target corpus of 1,000 crores. So tell me how much, when can we expect the first close of the fund and also the final close, and what are your expectations with the fund?
The IAN Alpha Fund was launched, I was registered with SEBI last year, but it was the marketing memorandum PPM was taken on record in the Q1 this year.
Okay.
So we have actually been able to offer the fund to investors only for about 4-5 months.
Okay.
We are making very good progress. We are almost 40-45% of the corpus more than subscribed, and we are expecting to do first close anytime soon. After the first close, we do have, of course, 18 months for final close. The Alpha Fund is a target corpus of 650 crores with a 350 crore green shoe. We expect to have very significant increase in our corpus compared to Fund 1. A lot of our LPs from Fund 1 have come back with larger ticket sizes. And there's a lot of endorsement of the results. Our recent exits have demonstrated how we continue to deliver value to our investors and not just valuation on paper. So that is a very good evidence of the results and the performance focus that we have at IAN for the Alpha Fund as well as the Fund 1.
Okay. And what kind of startups are you looking at investing? How many startups do you plan to back from the Alpha Fund, and what sectors are you focusing on?
So the IAN Alpha Fund is going to mirror many aspects of the IAN Fund 1. We expect to have a similar number of companies. IAN Fund 1 as well as IAN Alpha Fund are joint at the hip with the Indian Angel Network. And we partner with Indian Angel Network investments as well as engage our Indian Angel Network members for our fund investments. So as a network, since we invest in all sectors, the fund does not limit itself on any sectors at all. But as a partnership, our focus is to look at sectors which are for the future of the country, for the future of the technology. And so the primary sectors that you could take note of as attention areas, they're not exclusive, would be clean tech, health tech, biotech, agri-tech, edutech, fintech, manufacturing 4.0, deep tech, which includes AI, space, robotics. And then, of course, good companies in technology, SaaS, are all part of our mix, but the sectors I mentioned would be a somewhat extra emphasis from the partnership at the fund.
Okay. And in terms of check sizes, what would be the range that you would dole out to these startups?
So the IAN Alpha Fund is doing one thing different from Fund 1. Compared to Fund 1, we are keeping 30% up to 30% of the corpus for follow-on investments. Our initial investment target size is around 7 crores to 25 crores, $1 to $3 million if you convert it that way. And then for companies that deserve subsequent rounds of investing, we may choose to do follow-on investments subsequently.
Okay. And since you primarily look at early stage startups, so, tell me what kind of response did you see with Fund 1? How much dry powder are you still sitting on there? And are there plans to make more investments from that fund this year?
IAN Fund 1 was started deploying in October 17, and it is fully deployed as of October 21. So IAN Fund 1 is fully deployed. We are purely in portfolio management and exit and supporting our startups to grow and help our investors get exits. So Fund 1 is no longer investing. Alpha Fund, of course, will continue to, as soon as first close happens, which is imminent, we will have the typical 4-year commitment period. But here we do have the option of follow-on investments.
Okay, All right. And what kind of returns have you seen on the exits from your portfolio companies? From the fund one, how many startups have you bagged? And how has the growth been of your portfolio startups?
The Iron Fund 1 has done phenomenally well. It is doing among the best of class for our vintage in terms of money return to investors. We are seeing investments. Our companies have raised 9 times the capital that we have invested. Almost 75% of our investments have raised 9 times the capital that we put in. So our portfolio is very healthy, doing well.
So Ayan, they're saying that their portfolio is doing well. But with that, it is a wrap on this edition of Startup Street. From Ritu and me, goodbye and many thanks for watching. More news and updates coming up on the other side.